This night, we will look at taxation of non-resident company in Nigeria. Taxation of non-resident company in Nigeria. How do we tax non-resident company in Nigeria? What type of tax does non-resident company pay in Nigeria? So, the objective of taxation of non-residents in Nigeria is to provide general description of the Nigeria tax law as regards to non-residents. The non-resident we are referring to, they are non-resident company. They are non-resident company. First and foremost, let's differentiate between resident company and non-resident company. Let's differentiate between resident company and non-resident company. Resident company is a company that is incorporated in Nigeria under corporate and under Company and Allied Matter Act, CAMA. And their head office is located in Nigeria. Regardless of the ownership, a company that is registered in Nigeria under CAMA, Company and Allied Matter Act, and in which that head office of the company is in Nigeria, is also located in Nigeria. That company is called resident company. Another name for resident company is Nigeria company. You understand? Nigeria company. We know that any company registered in Nigeria, doing business in Nigeria, their profits will be liable to tax in Nigeria. But in the case of a non-resident company, in the case of a non-resident company, a non-resident company is a company that does not incorporated in Nigeria or that is incorporated under the law outside Nigeria. But that non-resident company derive income in Nigeria or they have a fixed base in Nigeria. Fixed base simply means permanent establishment. What that one means? They have branch, office, warehouse in Nigeria. So a non-resident company, any company that is incorporated outside Nigeria, but they have a fixed base, that means they have a branch, they have show, they have factory or warehouse in Nigeria. That company is a non-resident company. As regards to non-resident company will be liable to tax in Nigeria based on the profit that they derive in Nigeria. Based on what? The profit that they derive in Nigeria. Now, let's look at residential rule. How do we determine the income of a resident company that will be liable to tax in Nigeria? How do we determine the income of a non-resident company that will be liable to tax in Nigeria? First, residential rule for resident company means that income of a resident company, either individual or corporate organization, their income is to be assessed to tax based on their income that they derive in Nigeria and the income that the branch derive outside the country. Typical example of this is the topic that we treated last week, which is double taxation relief. When you look at that double taxation relief, we are looking at a situation whereby a company that has head office in Nigeria has a branch in another country. That word, branch, is relating to double taxation. I'm not using subsidiary. If I say it has a subsidiary, that one is not double taxation. So a resident company, the income of a resident company that will be liable to tax in Nigeria is the outside Nigeria. That income will also be liable to tax in Nigeria. But before the income of the branch of a resident company outside Nigeria will be liable to tax in Nigeria, we have to give them some relief. That relief is called double taxation relief. That was the question we treated last week. So residential rule for non-resident company. Residential rule for non-resident company. What is the residential rule for non-resident company? A non-resident company is going to be liable to tax only on the income or profit that they derive in Nigeria. Nigeria Tax Authority, we are only after the income or profit that they derive in Nigeria. We are not after the income or profit that a non-resident company derive outside Nigeria. Tax Authority is only after the income that they derive in Nigeria. And based on that, for a non-resident company to be liable to tax in Nigeria, that means they must have a fees base. Fees base means they have office in Nigeria, or they have a branch in Nigeria, or they have warehouse in Nigeria, or they have a factory in Nigeria, or they have a significant economic presence in Nigeria. What that significant economic presence in Nigeria means, they may not be physically present in Nigeria, but they are doing business in Nigeria through internet, through IT. They are rendering service to Nigeria domain through IT service, through IT, online service. So that is that. Now, let's look at the concept of a dual resident. Dual resident. Dual resident simply means a situation whereby a company or individual have more than one place of residence. Example of a dual resident company, a company that is registered in Nigeria and they are incorporated in Nigeria, they now have a branch in another country. That company, we can regard them as a dual resident. As related to an individual that have more than one place of residence, more than one place that he stay. Maybe that person has 3 houses, he's staying in Ibadan, he's staying in Lagos, he's staying in Ogun State. That person is a dual resident individual. As regards to individual, when an individual has a dual resident, the law say we should determine the principal place of residence of that individual, which means which out of the 3 places is claiming that is residing, which one is usual abode, which one is nearest to the place of work. His principal place of residence depends on the type of income, but we are not after that. We are after company. So in this our advanced task, we need to know a dual resident of a company. For a company, that means for a company to be regarded as a dual resident company, it means they have head office in Nigeria, they have a branch in another country, or they have parent company in Nigeria, they have subsidiary in another country. That means they are dual residents. A company that have more than one place of residence, more than one office in different country. When a company has more than one office in different country, that means that company is a dual resident company. Now, let's look at tax implication of interrelated company or a dual resident company. Let's look at tax implication when a company have more than one office in different countries. Tax implication of relationship between interrelated company. Interrelated company means parent company and subsidiary, they are interrelated. Branch and head office, they are interrelated. So let's look at the tax implication. First and foremost, the one we want to look at first is relationship between a Nigeria branch and a foreign parent company, or I can call it foreign head office. We want to look at the relationship or tax implication of a situation whereby a company, the head office of that company is in other country. They now have a branch in Nigeria. So relationship between Nigeria branch and a foreign parent company. That foreign parent company, you can use it as foreign head office. Meaning that ABC Incorporation, the company is located in Canada. They now have a branch in Nigeria. What is the relation? What is the tax implication of that situation? When they have head office in Canada, they have a branch in Nigeria. One of the tax implications is no incorporation will be required for Nigeria branch of a foreign parent company, of a foreign company in Nigeria. What that one means is that their branches in Nigeria, it is not required for that their branches in Nigeria to incorporate again under company and adding matter act in Nigeria. No. They don't need to incorporate. They will be bearing the name of their head office. ABC Incorporation is the head office. When they have a branch in Nigeria, they will be bearing ABC Incorporation. They don't need to register a new company called ABC Nigeria Limited. No. Because it's a branch, it's not a subsidiary. Assuming it's a subsidiary, it's a different bargain entirely. It's a different situation. Another tax implication is a Nigeria branch of a foreign parent company is to be treated as a corporate entity in Nigeria. That means the income and profit derived by such branch, the income and profit derived by such branch will be liable to tax in Nigeria. That Nigeria branch that the head office is in foreign country, the income and the profit that they derive will be liable to tax in Nigeria since they are doing business in Nigeria. The profit of the branch in Nigeria will be liable to tax in Nigeria. However, there are some conditions under which a Nigeria branch profit will not be liable to tax in Nigeria. There are some conditions under which the branch of a foreign company in Nigeria will not be liable to tax in Nigeria. What are the conditions? When that branch is used solely for storage of or display of goods, when the branch is used solely for storage or display of goods. Second, when the branch is used for collection of information only, maybe information collection center or after sales service information. In such case, that branch will not be liable to tax in Nigeria. Because the branch in these two situations where the branch will not be liable to tax in Nigeria, that branch is not selling good, they are displaying the good. If you want to buy the good, you order it online. But they are using the branch to display the good. Secondly, maybe they are using it to collect information about how people react on the products. So in such situation, the Nigeria branch of a foreign head office will not be liable to tax in Nigeria. Now, let's look at relationship between Nigeria subsidiary and a foreign parent company. Relationship between Nigeria subsidiary and a foreign parent company. They have a subsidiary in Nigeria. Their parent company is in abroad. What is the relationship on that? They have a subsidiary in Nigeria. Their parent company is in abroad. What is the relationship? The first one we look, they have a branch in Nigeria. The head office is in abroad. That is the first one. The second one we want to look now is a situation whereby a dual company has a subsidiary in Nigeria. Their parent company is in abroad. What is the tax implication? Number one tax implication, under the Nigeria tax law, that the subsidiary of a foreign parent company must be incorporated in Nigeria. Under the Nigeria tax law, the subsidiary of a foreign parent company must be incorporated in Nigeria. But look, when you look at the first one we talk about, Nigeria branch and a foreign head office, we said that branch don't need to be incorporated in Nigeria. But if it is a subsidiary, it must be incorporated in Nigeria. And the income that they derive, the profit that they derive in Nigeria will be liable to tax in Nigeria. Second tax implication under that, foreign equity participation may be 100% or less. Foreign equity participation may be what? 100% or less. But it must not less than 51%. Foreign equity participation may be 100% or less, but must not less than 51%. What does that mean? Let's use example. Mobi International Corporation is a foreign parent company. Maybe they're located in London. They now have a subsidiary in Nigeria called Mobi Nigeria Limited. That Mobi Nigeria Limited will be required to register under CAC in Nigeria. When at the point of registration, the shareholder of Mobi Nigeria Limited will be Mobi International Corporation. And the law say Mobi International Corporation can own 100% of the share of Mobi Nigeria Limited or less, but they must not own less than 51%. That is that. Another one, dividends distributed by Nigeria subsidiary of the foreign parent company are frank investment income and shall be exempted from tax in the hand of the parent company. You know, they have subsidiary in Nigeria and they have a parent company in abroad. Since the parent company is a shareholder to the subsidiary, at the end of the year, that subsidiary will be paying the parent company dividend. The law says that dividend is a frank investment income and it will be exempted from tax in the hand of the parent company. Another tax implication under this is, another tax implication under this. Another tax implication is when the foreign parent company render technical or consultancy service or management service to the subsidiary in Nigeria. Such service will be liable to withholding tax, which will be regarded as a final tax. What we mean by that is when the foreign parent company they render some service, professional service or management service or technical service to their subsidiary in Nigeria, or some training, they now charge their subsidiary in Nigeria. You know, it will be posted in the expenses of their subsidiary in Nigeria, while in the income side of their parent company is an income. So before their subsidiary pay them for that training or consultancy service render, the law says their subsidiary must deduct withholding tax of 10%. I failed to add it. So it's part of tax implication of Nigeria subsidiary and a foreign parent company. Another tax implication that is not included in this material is when the transfer pricing, when the parent company transfer good to the subsidiary, we are going to adopt transfer pricing regulation issued by FRS. When parent company transfer good to the subsidiary, we are going to adopt a transfer pricing regulation policy issued by what? By the Federal Inland Revenue Service. So let's look at the third tax implication. The third tax implication, overseas branch of a Nigeria company.
That's the fifth tax implication.
The third. The first one
I'm saying that's the fifth because you gave us two more.
The first relationship is relationship between Nigeria branch and a foreign parent company. The second relationship is Nigeria subsidiary and a foreign parent company. Abi?
Okay, I was referring to the points under that Nigeria
I'm not
referring.
It's not referring to the points.
Okay.
I'm referring to the relationship of a dual company or tax implication of a dual company. You know, I've mentioned first. Okay. The third one, overseas branch of a Nigeria company. Oversee what? Branch of a Nigeria company. What does that mean? A Nigeria company has a branch in other countries. That means the head office is in Nigeria. They now have a branch in other countries. This one was what we treated last week. This one is where we are going to adopt double taxation. They have a branch, a Nigeria company, a company that is registered in Nigeria, incorporated in Nigeria. They now have a branch in another country. Let's look at the tax implication. First and foremost, for tax purpose, the profit of an overseas branch of a Nigeria company is deemed to be derived in Nigeria and is therefore fully liable to tax in Nigeria. Let me explain that. That their overseas branch, their profit, we assume is derived in Nigeria, and we are going to tax it in Nigeria because it's a branch. Assuming it's a subsidiary, we don't have power to tax it. Because in that overseas country, that their branch, that branch of a Nigeria company in the overseas will not be registered as a registered company, it will not be incorporated. It will still be bearing Nigerian name. So that profit derived by the overseas branch, we are going to assume that it is derived in Nigeria and it is therefore liable to tax in Nigeria. But mind you, in the overseas country, that overseas branch, the tax authority in the overseas country too will have taxed that the profit, and in Nigeria too to tax it. That is the situation where double taxation arises as a result of that before we now tax it in Nigeria, since it has been taxed in another country, we have to give them some relief, some discount. That discount is called double taxation relief. What we are saying in essence is overseas branch of a Nigeria company, AB Nigeria Limited, they now have a branch in overseas. That the branch in other country will still be bearing Nigerian name. Since it's a branch, it's not a subsidiary. It does not have power to incorporate. We don't have power to incorporate it in other country. The law does not provide that branch should be incorporated again in other country. It will still be bearing Nigerian name. When it derives profit in overseas, the profit that it derives in overseas, the tax authority in overseas country will tax it. So they will pay tax on it. In Nigeria too, since it's a branch, Nigeria tax authority too, we want to collect tax on that profit. But before Nigeria tax authority collect tax on that profit, we are going to give a relief called double taxation relief. Another tax implication under that, assets in such a branch is eligible for capital allowance claim in Nigeria. Assets in such a branch are eligible for capital allowances claim in Nigeria. What that one means is that since we are claiming that when they make a profit in overseas country of a branch of their branch in overseas country, that profit we are going to tax it in Nigeria. Before we tax it, they have a right to claim capital allowance too, even though the asset of the overseas branch is not in Nigeria. The asset is not located in Nigeria, but they have a right to claim capital since we are and that loss incurred can be set off against loss incurred by the overseas branch can be set off against profit in Nigeria, provided that such loss were incurred from the same source. What we are saying in essence is, if the overseas branch make a loss and the head office in Nigeria make profit, when we are computing the tax liability of the operation in Nigeria, we are going to say Nigeria overseas branch. Assuming Nigeria operation has a profit and overseas branch has a loss, before we get the total, we can remove the loss made by overseas from that Nigeria operation, so that what we are going to have at the total, the profit will be reduced. So far as the business that they are doing in overseas branch is the same as that the Nigeria head office. another tax implication under overseas branch of a Nigeria company. Double taxation relief is available against foreign tax suffered. I've explained this. Before we tax the profit of that overseas branch of a Nigeria company, we are going to give them a relief, a discount, an allowance called double taxation relief. Assuming they pay 200,000 tax in abroad, and when we compute the tax that overseas branch we pay in Nigeria, is supposed to pay 500,000 tax. We're not going to say, because he has paid 200,000 tax, let's give him some relief. Instead of you paying 500,000 tax in Nigeria, pay only 400. I'm using that as an example. Only 400. That one does not mean we are going to say all the tax he paid in abroad is what we are going to use as a relief. No, only parts. Only parts. So that is overseas branch of a Nigeria company. Another tax implication of a dual company. Overseas branch, relationship between overseas branch of a Nigeria, overseas subsidiary, of a Nigeria company. A subsidiary, a Nigeria company, which means parent company. The parent company is in Nigeria. They now have a subsidiary in where? In another country. What is the tax implication of that? For tax purpose, the profit of the overseas subsidiary is not deemed to be derived in Nigeria, and we therefore not liable to tax in Nigeria. This one is subsidiary, not a branch. The third one we look at there before this one is branch. But this one is branch. This one is subsidiary. They said that profit of the overseas subsidiary will not be deemed to be derived in Nigeria, and it is therefore not liable to tax in Nigeria. Because the overseas subsidiary is going to be registered as a corporate entity in the overseas country under their law. Second, dividends received from the overseas subsidiary will be considered for Nigeria tax purpose. The parent company is in Nigeria. They have subsidiary in overseas. The parent company, every year, they will be receiving dividend from the overseas subsidiary. That dividend is going to be liable to tax in Nigeria. Nigeria government will collect tax on it, since it is an income to the parent company. Technical and management fee paid to the Nigeria company by the overseas subsidiary too will be subjected to tax in Nigeria. The parent company is in Nigeria. They have a subsidiary in abroad. Parent company may decide that, I want to render technical and management service to my subsidiary. When they render it, subsidiary will pay them fee. That fee is an income to the parent company, and that income is subjected to tax in Nigeria. Let's look at circumstances. Capital allowance will not be claimable on the property, plant, and equipment of overseas subsidiary. Another tax implication. Capital allowance is not going to be claimable on the property, plant, and equipment of an overseas subsidiary. Since they are not paying tax in Nigeria, so they cannot claim capital allowance to in Nigeria, that their overseas subsidiary. So the next heading we should look at is, let's look at circumstances under which a non-resident company, a company that does not register in Nigeria, will be liable to tax in Nigeria. What circumstances? Number one circumstances is where that non-resident company has a fees base in Nigeria. They have what? A fees-based. A fees-based simply means a permanent establishment. That means they have office. Example of a fees base means facilities such as factory, office, branch. When a non-resident company has a branch in Nigeria, that the profit of their branch in Nigeria will be liable to tax. When they have office in Nigeria, the profit of office in Nigeria will be liable to tax. So, example of a fees base: office, branch, oil well, installation point, assembly point. All these are fees based. So, number one circumstances where a non-resident company will be liable to tax in Nigeria is where that non-resident company has a fees base in Nigeria. Number two circumstances is where the non-resident company derive income through dependent agents. Where the non-resident company derive what? Income through what? Dependent agent. Under this taxation of non-resident, there are two types of agents. We have independent agents and what? Dependent agents. Independent agents, they deal on behalf of non-resident company in the ordinary course of its own business. What independent agent simply means is an agent that can exist without the principal. Even if the principal is not sending good to them, they will still continue to do business. Even if the principal is no more in business, they will still continue operating. That one is independent agent. But a dependent agent means an agent that only depends or solely depends on the principal good. They only depend on the principal good. The only good that they are selling in their store is only the good of their principal. What that one means is that if the principal does not send good again, that agent ceases to exist. If anything happens to the principal, it will affect the agent. So in such case, we said income derived in Nigeria through dependent agent. Since it is a dependent agent, when a non-resident company send a good to dependent agents, when they make profits on such good, that profit will be liable to tax in the name of the non-resident company, not the name of the dependent agent. But when a non-resident company send a good to independent agent and they make a profit, that profit will be liable to tax in the name of the independent agent, not the name of the non-resident company, which is the principal. So that is number two circumstances. Number three circumstances, where the non-resident company derive income from turnkey projects. When the non-resident company derive income from what? Turnkey projects. Turnkey project simply means single contract, one-off contract, one-off project that involve delivery of goods, installation of software or equipment, construction of plant or building. Turnkey project simply means that non-resident company, they came to Nigeria to do a one-off project, one-off service, one-off contract. After they finish that contract, they will go back. When they in such case too, when they derive profit from that project or key project or one-off contract that they do, that profit too will be liable to tax in Nigeria. But In the case of turnkey projects, they don't have office. They just come to Nigeria to come and sell goods or deliver goods or install software or do construction. They don't have office in Nigeria. In such case, if they want to tax them based on turnkey project, they will only pay withholding tax. They are not expected to file tax return. They will only pay withholding tax, and that withholding tax that they paid on that income is one-off, is the final tax. Unlike the first one that we mentioned, when they derive income, when they have a fixed base in Nigeria, they have office in Nigeria, they have a branch in Nigeria. If they want to pay their tax, they will pay both company income tax and education tax. They will file tax return. They will prepare audited accounts because they have office in Nigeria. But in the case of turnkey, they don't have office in Nigeria. They just came to Nigeria to do a one-off project or to deliver an item or to do installation. Once they finish, they are going back. The tax that they will pay in that case is only withholding tax. But in this first instance, when they have a fixed base, they will pay company income tax, education tax, and they will file tax return. They will submit the audited account to FRS. But in the case of turnkey, they don't need to do that. In the case of when they derive income through dependent agents too, they will file tax return, prepare audited account, pay company income tax, pay education tax. Because that the dependent agent will have office in Nigeria. So that is that. Another circumstances where a non-resident company will be liable to tax in Nigeria is where the non-resident company derive income from professional consultancy, management. They derive income from professional consultancy, management, and technical service rendered in Nigeria. When they render professional service, management, technical service in Nigeria, in such case, they will be liable to tax in Nigeria. But all these kind of services that they render in Nigeria, the type of tax that they will collect from them is withholding tax. They will not collect company income tax, education tax. They will not ask them to come and be filing tax return or prepare audited financial statement. No. Because in this regard, they may not have a fixed base in Nigeria. They may not have office in Nigeria. Another one is when the non-resident company derive income from investment activities. They derive an investment income in Nigeria. When they derive rent in Nigeria, or interest in Nigeria, or royalty in Nigeria, or dividend in Nigeria. All these too, we will not ask them to come and be filing tax return, to come and be preparing audited account. No, they will just pay one-off tax or withholding tax. And that withholding tax is regarded as what? Final tax. Another circumstance where the non-resident company derive income from award of contract to a Nigeria company, but that contract is now subcontracted to a non-resident company. A Nigeria company was given a contract, and that company cannot do the contract. They now invite a non-resident company. Let me subcontract it to you. In such case too, they will be liable to tax in Nigeria from the proceeds that they derive from that subcontracted project. Let's look at an instance that is another heading: turnover assessment for a non-resident company. There is a situation where when we want to assess a non-resident company to tax, we just have their turnover, we not have the relevant expenses. Take for instance, a non-resident company came to Nigeria to come and deliver goods. That good that they deliver in Nigeria is their turnover. They don't have any relevant expenses as regards to that. In such case, we want to assess them based on turnover. What the law is saying now is when we only have turnover for a non-resident company. For us to tell them that they will be liable to tax in Nigeria, we need to determine the accessible profit. And the accessible profit, according to the law, will be 20% of their turnover. Assuming a non-resident company deliver a good in Nigeria, they came to Nigeria to come and deliver a good or to come and sell a good only. And that good, when they finish selling it, the good worth 3 million naira. If you want to tax them in Nigeria based on that turnover, the law says we are going to assume that 20% of the 3 million naira is the accessible profit. And when we get the accessible profit, we now go and they will now pay only company income tax of 30%. They will not pay education tax. They will pay 30% of the accessible profit. You know, the accessible profit is 20% of their turnover. Once we get that, in my example now, 20% of 3 million, that is 600,000. For us to tax them now, the tax that they will pay, company income tax that they will pay, 30% of 600,000. That is turnover assessment. So let's look at a situation where income derived by non-resident company from having significant economic presence. What does significant economic presence mean? According to Finance Act 2020, a company may not be in Nigeria, they may not have office in Nigeria, but they may be deriving income in Nigeria. They may be deriving income through IT, online service. In that case, despite that they are not in Nigeria, but they are deriving income through Nigeria domain, website domain, that means they have significant economic presence in Nigeria. And the law said when such income is more than 25 million, they derive income from online service. They are not coming to Nigeria. They are rendering online service to a Nigeria environment online. Maybe they are rendering training to one Nigeria company. When that income that they derive is more than 25 million, in such case, they will be liable to tax in Nigeria. So significant economic presence simply means when a company is operating or their presence through IT online, even if they are not having office or physical presence in Nigeria, they are doing business in Nigeria domain. In that case, they will be liable to tax in Nigeria. Now, let's look at a question. Question 1B. Question 1B. Question 1B. Question 1B. Question 1B is Jupiter Mikado Incorporation, a non-resident company, carry out some activities during the year ended 31st December 2013. Jupiter Mikado is an oil service company. A careful study of its tax return filed with FRS show the following: income from Mobi Producing Nigeria Unlimited, income from Shell Petroleum Development Company, income from Chevron Nigeria Limited, income from Palm Ocean Nigeria Limited, income from Ajib, income from Philip Oil Company, income from Kono Oil, income from Continental Oil, income from Snepco. The FRS has to assess and charge on what? On turnover basis. This non-resident company were only giving their turnover. Even the note has told us they assess them on turnover basis. Required, calculate the turnover. B, compute the tax payable by the company, assuming it has a withholding tax credit of $15,000. First is to get the turnover. The question is in dollar. We add all the income together. We add all the income together. That is the turnover. We add all the income together. That is the turnover. So the turnover is $785,000, though is in million. How do we get the tax payable? Since we know the turnover, we assume that 20% of the turnover is the assessable profit. You know, based on what I explained, turnover assessment of a non-resident company. When you only have a turnover of a non-resident company, you don't have expenses. You assume 20% of the turnover is the assessable profit. 20% of 75,000, it will give us 157,000. That is the assessable profit. Based on this assessable profit, they will now pay tax. They will pay company income tax of 30%. 30% of 157,000 is going to give you 47,100. That is the company income tax that they're supposed to pay. But at the point of receiving the income, all this income, we are told in the question that they have already paid withholding tax. They have already deducted withholding tax. They have a withholding tax credit note of 15,000. So from the tax, company income tax that they're supposed to pay, which is 47,100, we less the withholding tax credit note, the tax that has already been deducted. So that means the net tax payable is going to be what? 32,100. The net tax payable will be what? 32,100. That is the net tax payable. That is what the examiner asks us in this question. So let's look at the second question. The second question is the major question, and this question is one of the compulsory questions. When I can set this question, is the number one question, and I can have tested this question more than 3 times or more than 4 times. This second question is the major question on taxation of non-residents. So somebody should help us read this second question. Anybody can help us read?
Okay, good evening. I'm reading.
Between Russia and Ukraine started some years ago and has been having serious negative impacts on most corporations operating in the two countries. So consequently, many corporations in both countries have shut down their businesses, while those still operating are incurring huge losses. Many multinational enterprises, that's MNEs, in the two countries have relocated their businesses to countries considered to be safe and investment friendly. So Milton Corporation is a manufacturing company that was incorporated in Japan in 2001 and have subsidiaries in Ukraine and some Asian countries. The Ukraine subsidiary happens to be the highest contributor to the group performance over the years. However, due to the war in Ukraine, most of the resources have been diverted to the Asian countries' operations, with plan to equally exploit African markets. In view of this, Milton Nigeria Limited was incorporated in Nigeria in January 2021.
Okay.
So Milton Nigeria Limited is the subsidiary of Milton Corporation. The company is into
Please,
manufacturing of
please,
fast-moving consumer
hold on,
goods.
hold on, sorry.
Yeah,
Milton Nigeria Limited is what?
a
Is the what?
subsidiary,
Subsidiary of what?
Milton Corporation.
This is the major point we need to note in this question. Milton Nigeria Limited is a subsidiary to what? Milton Corporation. That means, what type of relationship is this?
So a foreign parent company and a Nigerian subsidiary.
Nigeria subsidiary. Nigeria subsidiary of a foreign parent company. When you know this, you will now go back to the notes under the tax implication. You look at what is the tax implication of Nigeria subsidiary and a foreign parent company. Under the tax implication, the profit of the Nigeria subsidiary will be fully liable to tax in Nigeria. There is nothing concerned on with the profit of the parent company, because the profit of the parent company is not derived in Nigeria, and the parent company is not a Nigeria company. It is only the Nigeria, the subsidiary that is in Nigeria company. So this relationship, Nigeria subsidiary and foreign parent company. So continue.
So Milton Nigeria Limited is the subsidiary of Milton Corporation. The company is into manufacturing of fast-moving consumer goods, and its operational base in Nigeria is located in Esaoke, Osun State. Milton Nigeria Limited commenced business in Nigeria in January 2021, and its financial year end is December 31, which is the same as its parent company, Milton Corporation in Japan. The first set of FS prepared by Milton Nigeria Limited was for the year ended December 31, 2021, and was audited by the Nigerian branch of a reputable audit firm in Japan. So on September 15, 2022, Milton Nigeria Limited received a letter from the FIRS in Osun State requesting for the annual corporate tax returns of Milton Nigeria Limited. The general manager of the company was surprised to receive such a letter from the FIRS. He claimed that the company had paid PIT and personal income tax of its employees and directors, the value-added tax on imported equipments, and relevant custom duties. He argued further that since the parent company is not registered in Nigeria, there is no reason why it should be liable to corporate taxes in Nigeria. So the MD of the subsidiary company in Nigeria, with the approval of the head office in Japan, appointed your firm as the company's tax consultant to help unravel the issue of payment of corporate taxes by resident and non-resident companies operating in Nigeria. He also submitted to your firm the statement of profit or loss for the year ended December 31, 2021, after conversion of the transactions in the head office's Japanese currency yen to the Nigerian naira. So then we have the table.
Okay, thank you very much. Thank you. They now give us the accounts. They give us the head office results. They give us the Nigeria subsidiary results. The question is the head office profit liable to tax in Nigeria? The parent company, which is in foreign country, is it liable to tax in Nigeria?
No, sir.
Huh?
No, it's not.
No. That means in the solution to this question, we are going to ignore all the figure given to us under Japan. Because it is only Nigeria, which is a branch, which is subsidiary, to a foreign parent company. That subsidiary in Nigeria, it is only that profit of that subsidiary that will be liable to tax in Nigeria. The profit of the parent company, which is another country, is not going to be liable to tax in Nigeria. I want to ask a question. Assuming they have head office in Nigeria, this one is head office and branch. It's not subsidiary. They now have a branch in Japan. With the profit of the Japan, we liable to tax in Nigeria?
Yes, it would be.
Yes.
It will be liable to tax in Nigeria. But in this situation now, the parent company is in Japan. The subsidiary is in Nigeria. In Nigeria, we are only after the profit, the tax of the subsidiary. Nothing concerned us with the parent company. So that is good. When students don't read this question very well, most of the students, they're convinced. They thought it's a situation whereby they have a branch in Japan. They now have a head office in Nigeria. They are now adding the two together. They now go and apply the issue of double taxation. Double taxation does not arise in question. No, only Nigeria subsidiary profit will be liable to tax in Nigeria. So we are giving total resource income, total income, production. Expenses is also given. We have different expenses. All these expenses are given to us. At the end of the day, your firm was presented with this additional information. What are the additional information? Miscellaneous income. Miscellaneous income consists of income realized from sales of component part to head office in Japan, and the transaction was certified to have been made at an open market. Legal expenses comprises of debt collection, preliminary expenses, land acquisition, retainership fee. Allowance for doubtful debt comprises of allowance for doubtful debt, specific allowance for doubtful debt, bad debt written off. Rent repair maintenance include improvement to office building, repair of plant and machinery. Administrative expenses include court fine, office expenses, subscription to Nigeria and Japan trade mission, provision of Japanese book to public secondary school. Schedule of qualified capital expenditure is also given. We acquire some qualified capital expenditure. That is for all these are for the Nigeria subsidiary. Now, required as a company tax consultant, your firm is required to prepare what? A letter to the management of Milton Nigeria Limited, taking into consideration the tax implication of the following. A, we are asked to distinguish between what? Resident company and what? Non-resident company. B, we are asked to mention the tax implication of relationship between Nigeria branch and a foreign parent company. C, relationship between Nigeria subsidiary and a foreign parent company. D, tax implication of overseas branch of a Nigeria company. E, tax implication of overseas subsidiary of a Nigeria company. F, circumstances under which profit of a non-resident company will be liable to tax in Nigeria. G, advice on the corporate tax payable by the two companies on their operation in Nigeria. This question, if you attend it, you have to answer it in form of report writing, letter writing, because the requirement is your firm is required to prepare a letter. So you are not going to say, this and this. You are going to arrange it in form of report writing. In the question, the examiner did not mention the name of the tax consulting. When you are doing your own solution, you will form a name of a tax consultant firm. Look at my own solution now. My heading, my letter heading will be ABC and Co. Tax Consultants. The address of my firm, ABC Avenue, Lagos. That will be the heading to this question. After that, February 14, 2024, date. You now address the letter to who? The managing director, Milton Nigeria Limited. We are giving the address in the report. Plot 25 SLK, Agbata, Osun State. Dear sir, what does the company ask you to unravel in the question? What does the company ask you to unravel in the question? Which is the theme of this question. As a task, your firm appointed the managing director of the subsidiary in Nigeria with the approval of the head office in Japan, appointed your firm as who? As a tax consultant to help them unravel the issue of what? Corporate taxes by resident and what? Non-resident company. That is the main heading to this question. Heading to this question. Your letter head, subject of the matter, taxation of resident company and non-company in Nigeria. You want to do it in form of report writing. Your subject of the matter is very key. After that, we refer to your mail dated February 10 on the above subject matter, requesting not to unravel the issue of what? Payment of corporate taxes by resident and non-resident company in Nigeria. Please find below the relevant information that will facilitate better understanding of the solution. A, after you write this, you can now go to the point that they ask you to address in your letter. What is the first point? To distinguish between what? Resident company and what? Non-resident company. What is the difference? Resident company is a company that is incorporated under Company and Allied Matter Act in Nigeria. Why non-resident company is a company that does not incorporated or that is incorporated under the law outside Nigeria, but they have a fees base in Nigeria. They have a fees base in Nigeria. But they also derive what? Income in Nigeria. Any company that does not register in Nigeria or incorporated in Nigeria but derive income in Nigeria, that company is a non-resident company. But a company that is registered under Company and Allied Matter Act in Nigeria is a Nigeria company, which is a resident company. B part of the question. They ask you what is the relationship or tax implication of Nigeria branch. They have a branch in Nigeria. They have a parent company abroad. They have an head office in abroad. What is the tax implication? That the branches in Nigeria is not required to register under CAC, Corporate Affairs Commission. But the profit of the branches in Nigeria will be liable to tax in Nigeria. That is the only solution where the profit of the branches will not be liable to tax in Nigeria is when they use that branch for storage of goods or display of goods, or when they use the branch for collection of information. In that case, the profit will not be liable to tax in Nigeria. C, we are asked to mention the relationship or tax implication of a Nigeria subsidiary and what? A foreign parent company. They have a parent company in abroad. They now have a subsidiary in Nigeria. Nothing concerned with profit of their foreign parent company, because they are the parent company is a foreign country. It's not a Nigeria company. What we are after here is that their subsidiary in Nigeria. So the tax implication is the subsidiary in Nigeria must be incorporated in Nigeria. Look at this case study we are doing. Milton Nigeria Limited is a subsidiary to what? Milton Incorporation. You can see that Milton Nigeria Limited registered under CAC in Nigeria. And the profits derived by income or profit derived by Milton Nigeria Limited will be liable to tax in Nigeria. Foreign equity participation may be 100% or less, but it must not less than 51%. When Milton Nigeria Limited distribute dividends, Nigeria subsidiary, they give out dividend to their parent company, which is foreign parent company. That dividend will be subjected to withholding tax of 10%. The third one, the fourth one, they are asking us, what is the tax implication of overseas branch of a Nigeria company? This one means they have head office in Nigeria. They now have a branch. In this topic, branch is different from subsidiary. We should know that. Branch is different from subsidiary. They have branch in overseas. Their head office is in Nigeria. In that case, the profit of the overseas branch is going to be assumed to be derived in Nigeria and is going to be liable to tax in Nigeria. The overseas branch can claim capital allowance on the assets acquired, even though that asset is not in Nigeria, since they are paying tax in Nigeria. In some instances, when the overseas branch made a loss, such loss can be relieved against the profit of the Nigeria head office. As far as that, the business that both head office and the overseas branch are doing, they are from what? The same source. And double taxation relief shall also be available for any foreign tax sufferer. E part of the question said, what is the tax implication of overseas subsidiary of a Nigeria parent company? They have the parent company is in Nigeria. They now have a subsidiary in other country. The profit of the overseas subsidiary is not deemed to be derived in Nigeria and therefore not liable to tax in Nigeria. When the parent company that is in Nigeria receive dividend from the overseas subsidiary, that dividend will be liable to tax in Nigeria. Secondly, when the parent company provide technical and management service to the overseas subsidiary, that technical and management service will be liable to tax in Nigeria because it's an income to the parent company. Now, they say, what are the circumstances where income of a non-resident company will be liable to tax in Nigeria? I mentioned that. Number one, when the non-resident company has a fixed base in Nigeria. Number two, when the non-resident company derive income through dependent agency operation in Nigeria. Number three, when they derive income from turnkey projects. Number four, when they derive income from professional consultancy, management, and technical service rendered in Nigeria. Another one, when they derive income from investments. The last part of the question said we should compute the company income tax that the company will pay. If you go to the question, only the Nigeria subsidiary which meet on Nigeria that will be able to tax in Nigeria. So now let's look at their profit. The net profit of their subsidiary is 237,818. We add back disallowable expenses. What are the disallowable expenses in this question? Let's check. What are the disallowable expenses? Salaries and wages is allowed. Employer contribution to pension is allowed. Electricity and rates is allowed. Legal expenses is allowed if there is no note. Share of head office expenses is allowed. What of depreciation? Is it allowed?
It's not.
No. So our first disallowable expenses that we are going to add back to the net profit is depreciation. Allowance for doubtful debt. We have the breakdown. We go and check the breakdown. So another thing under the head of under the subsidiary is value-added tax on essential item is allowed. Entertainment is allowed. Transport and traveling is allowed. Printing and stationery is allowed. Telephone and postage is allowed. Motor vehicle running expenses is allowed. Foreign exchange loss provision call.
No.
It's also allowed. Is it allowed or not allowed?
No, not allowed.
It is not allowed. Foreign exchange loss provision is not allowed. It's a provision. Assuming they have actually made that loss, is it allowed?
Yes, if it's real, if it's realized.
If it's real, realized exchange loss is allowed. The exchange loss provision is not allowed. Another name for foreign exchange loss provision, in some textbooks, they will call it unrealized exchange loss provision. So it is not allowed because it's a provision. We add it back. Debenture interest, is it allowed? It is allowed. Interest on loan, interest on debenture is allowed. Loss on revaluation of non-current assets.
No.
Is it allowed?
No.
It's not allowed.
No. Loss on revaluation of non-current assets. Impairments, amortization, all those things, depreciation, they are not allowed in tax. We don't test for impairments. It is your corporate reporting. In tax, we don't say we make provision for revaluation, loss on revaluation of an asset. No. The question is, who do you pay? Does it involve cash payments? No. So it is not allowed. Repair and maintenance is allowed if there is no notes. Audit and accounting fee is allowed. Administrative fee is allowed if there is no notes. So now let's go to the notes of some of those items of expenses, some of the breakdown of the item. Like legal expenses that we have in this question. Look at the legal expenses. 55460. They give us the breakdown of it. This 5460, we are giving the breakdown. That means part of it is allowed, part of it is not allowed. Legal expenses comprises of what? Debt collection, preliminary expenses, land acquisition, retainership fee. Out of these 4 items, which one is allowed, which one is not allowed?
Land is allowed.
Land acquisition.
Land acquisition is what?
No, debt collection is
No, it's
allowed.
not allowed. It's not allowed.
I want to ask,
CGT.
debt collection, is it allowed or not allowed?
Is allowed.
It's allowed.
Allowed.
It's allowed. You can incur legal expenses to take your customer to court to collect your debt,
Yes.
to take them to police station to collect your debt. Because in the long run, more money, more revenue will still come to you when you recover the debt. Abi?
Yes.
Preliminary expenses, expenses you incur before you start a business, is it allowed?
It's allowed.
It is
It's
not
not,
allowed.
it's not allowed.
No.
These expenses, you have incurred it when you start a business, before you start a business. When you have actually started a business, you now want to use it as an expenses. No, it's not allowed. What about land acquisition? You pay legal expenses for land acquisition. Is it allowed?
It's
No.
not allowed. Because the capital.
It is not allowed.
No.
Because
It's
legal
supposed to be
expenses
capitalized
you
with
pay,
the cost of the land.
according to your IAS 16, it's supposed to be capitalized to the cost of the land. It's a capital cost.
Expenditure.
Retainership fee, is it allowed or not allowed?
It's allowed.
It is allowed.
I'm in class. Michael, go. Go,
Retainership fee
go.
simply means your lawyer, your legal practitioner, every year to retain them so that they will still be serving as your company lawyer. There is an agreed fee between two of you. It's allowed. So the two that we are going to add it back to adjusted profit is what? What are those 2 items under legal expenses we are going to add it back to the net profit?
Land acquisition and preliminary expenses.
Land acquisition and preliminary expenses. Let's go to allowance for doubtful debt. Allowance for doubtful debt. We have the total amount of our allowance for doubtful debt is 15,975. If you go and look at under the expenses, allowance for doubtful debt, you will see that 15,975. Allowance for doubtful debt. You can see it, 15,975. Then now goes the breakdown. Look at the breakdown. First one, under the breakdown, they call it allowance for doubtful debt. Second one, specific allowance for doubtful debt. Third one, bad debt written off. Out of these 3 items, which one is allowed among them? Which one is disallowed?
Allowance for doubtful debt is disallowed. Specific allowance is allowed. Bad debt written off is allowed.
Thank you very much, my brother. What this allowance for doubtful debt, what do we assume is?
General
I think because
allowance.
it's not
We are going to
specific,
assume
so
it's
it cannot be
general
tied to a
General
particular.
provision.
because they have given us what? Specific. We assume is what? General.
It's a general provision.
That is the reason why we disallow it. Because we have been given specific. That means the first one will be general. We are going to disallow it. Under repair and maintenance, it comprises of improvement to office building, repair of plant and machinery. So these two, is there anyone that is disallowed? Or all of them is allowed?
Improvement disallowed.
Improvement is disallowed because when you improve your office building, it's office renovation, it's a capital expenses, it's an asset. You need to claim capital allowance on it. It's not an expenses. It's supposed to be capitalized. Repair and maintenance, repair of plant and machinery is allowed. Improvement of office building is disallowed. Administrative expenses, look at it. First one, court fine. Second one, office expenses. Third one, subscription to Nigeria-Japan Trade Mission. Third one, the fourth one, provision of Japanese book to some public secondary school. Which one is allowed? Which one is disallowed?
Court fines are disallowed. Office
Disallowed.
expenses are allowed. Subscription to the Nigerian-Japan Trade Mission is allowed, while provision of Japanese books to the secondary schools are disallowed.
My brother, you have tried. Court fine is allowed. Office expenses, cost fine is disallowed, sorry. Office expenses is allowed. Subscription to Nigeria Japanese Trade Mission, allowed. Provision of Japanese book to some public secondary school. When you provide Japanese book to some public secondary school, it's allowed, my brother. Why do you want to disallow it?
Because I was feeling it does not fulfill the WREN
It's
principle.
public schools.
I don't think it's necessary. I
Public
don't know.
school,
It's public schools.
public school, public school
But what about if it's private schools?
is not allowed.
It's allowed.
If it is private school, it's not allowed. But if it is public school, it's allowed. So let's go to our computation. Our computation. In our computation now, we have our net profit 237,818. We add back disallowable expenses. Number one is depreciation, which is 12,870. Foreign exchange loss provision, 3,150. Allowance for doubtful debt, 7,145. Loss on revaluation of non-current assets, 2,831. Preliminary expenses, 2,360. Legal expenses, land acquisition, 1,550. Repair and maintenance, improvement of office building, 3,250. Administrative expenses, only court fine. When you add all those disallowable expenses back to the net profit, you are going to get adjusted profit of 276,574. In the question, we are not giving capital allowance direct. We are giving qualified capital expenditure. So the examiner asks us to compute capital allowance. So part of our note is to compute what? Capital allowance. in the capital allowance computation, we have different type of assets: factory building, office building, plant and machinery, motor vehicle, office furniture, office equipment. For factory building, initial allowance is 15, annual allowance is 10. Office building, initial allowance 15, annual allowance 10. Plant and machinery, 50-25. Motor vehicle, 50-25. Furniture and 15, 25-20. Office equipment, 50-25. You put your cost. When you put your cost, you compute your initial allowance. You will compute your initial allowance based on your cost. Once you do that, you compute your annual allowance. At the end of the day, our total capital allowance is going to be 53,094 naira. My other colleague have taught us how to compute capital allowance. Abi, take for instance, let me give one example. For this first one now, how do I get initial allowance? 15% of the cost, 15% of 25,000 is going to give us 3,750. If I want to get the annual allowance, AA, I will now set 3,000, 25,000 cost minus initial allowance divided by number of years. This building is going to spend how many years? How do I know? If I want to know the number of years, 100% divided by 10, we are going to get 10 years. Building is going to spend 10 years. For plant and machinery, 100% divided by 25. That means plant and machinery will spend 4 years. For furniture and fitting, which is 20, is the annual, 100 divided by 20. That means furniture and fitting will spend 5 years. So, for you to get your annual allowance, your cost minus initial allowance divided by number of years. In the case of this building now, 25,000 is the cost. Initial allowance is 3,750. When you minus it, when you minus it from 25,000, the balance, you divide it by what? 10. When you divide it, you are going to get 2,125. In the case of the office building, 17,400 less the initial allowance. Divided by number of years, which means 17,400 minus 2,610 divided by 10. You are going to get annual allowance of 1,479. That is how you do capital allowance. Ladies and gentlemen, capital allowance is very compulsory. Our number one question in the exam is going to include computation of capital allowance. So let's take note. The lecture material, the video lecture on capital allowance, let's try and listen to it often and often. It's very important. Our number one question will involve computation of what? Capital allowance. So let's go back to the solution. You less your capital allowance, you get total profit or taxable profit. Your total profit or taxable profit is 223,480. You can now compute your tax liability. Your company income tax 30% of your total profit or taxable profit. Your TET, tertiary education tax, 2.5% of your what? Of your adjusted profit. Education tax is computed on adjusted profit. Why company income tax is computed on what? Total profit. In this case, I use 2.5% because the year of assessment is 2023. As at then, it was 2.5%. Some are of the opinion that is 3%. It depends on what will be given to you in the exam. You don't need to argue on this. At the back of your exam, you will be guided whether to use 2.5 or 3%. So your company income tax is 67,044,000, while your education tax is 6,914,350. You cannot compute your police development levy. Police development levy is based on your net profit. Your net profit is computed on your net profit. If you look at the net profit is 237,818. So it's based on your net profit. 0.005% of your net profit. So that is how we get the tax liability for this company. Any question, any query, any issue? Any question, any query, any issue? Any question?